All right. Let me welcome in Pratik Gupta as well, who's joining us this morning. Great to have you with us, Pratik. And it's an interesting time with markets on tenterhooks, given what's happening in the US elections and also the rising caseloads of coronavirus and, possible lockdowns already, of course, in Europe, but also spreading otherwise around the world. How are you viewing the situation currently? We've been trying to look at positive cues domestically, but at the moment, we seem to be riding under the shadow of what's happening around the world.
Yes, you're right. Good morning. The near-term outlook is obviously clouded by the risk of a virus resurgence in Europe, what that will do to the global economy. A bigger event in our view is also the US elections. If you have sort of the equivalent of a hung parliament over there, where a lack of a clear verdict, that could delay policy making. And in India, of course, while so far in the last month or so, we've seen virus cases coming down, but there's always a risk that this thing comes back. We have the festival season going on. And there is a risk that this virus could explode once again, and we could have another round of localized lockdowns, and which could disrupt supply chains and demand and so on. But I think the bigger picture over here is, in our view, that if you sit back and look beyond the next few weeks or next few months, I think the overall global situation doesn't really change, which is that, you've got central banks around the world which are printing money. The Fed, for example, has expanded its balance sheet to more than $7 trillion this year and is on track to expand it even further, irrespective of who comes into the US White House. You look at the ECB. Just yesterday, once again, they've announced that they'll be doing another stimulus. They think the economy needs further easing measures. And if you look at back to the US, irrespective of which government comes in, you will see a fiscal stimulus package of around roughly $2 trillion, depending on Democrats or the Republicans. The number could change a little bit, but by and large, they're both aligned on one aspect, which is the economy in the US does need more fiscal stimulus. That in turn should lead to a weaker US dollar, which generally tends to have results in more positive flows to EM assets and emerging market equities in particular. And in that context, India should also benefit. So I think overall, if you ignore the short-term noise, the longer-term outlook is perhaps not as pessimistic as many are making it out to be. I guess the key risk is obviously the virus over here in India, and hopefully we will continue the pace of recovery going forward.
Absolutely. I would just want to get your sense on flows as well and how you feel they may be impacted given the current scenario. We saw a dip, then we saw a climb back. What's really your sense going forward?
So I think the global flows are obviously impacted by risk appetite and sentiment, and obviously the underlying flows into their own asset classes. In India, most of the FIIs which come in, a lot of the money comes in from EM funds. There are obviously there are global funds which invest directly as well. And then you have the India dedicated asset category. The India dedicated flows, we do not get a sense so far that they're seeing any big inflows as yet, but I think a lot could change after the US elections. If there's a lot of liquidity, if there's a lot of positive sentiment towards EMs, then we think some asset allocators, based on our discussions, looks like they will go after and try and find individual countries to invest in rather than invest in the overall EM basket. But in general, in our discussions with our global clients, we are hearing of strong inquiries into EM funds. This actually, I think, has happened more in the last few weeks, and more so after Powell's commentary last month, wherein he's effectively indicated that you will have low interest rates for much longer. And so if you have a reasonably stable political environment in the US and the fiscal stimulus package proceeds, I think the flows into EMs, and that would include India as well, should actually pick up. Keep in mind that India has actually underperformed the emerging market index this year. So that's another reason why, despite our somewhat weakish growth outlook, we are still reasonably attractive, although we are no longer the hot favorite, but we're still reasonably attractive.
Pratik, markets never react to the same event twice in the same fashion. In similar way, the recovery may be very different this time around. What we saw recover from the March lows, at least in India, was a frenzy towards IT and pharmaceuticals. That trade off late purely because of, now valuations getting pretty ripe over there and overpriced and overbought in these two categories. We're seeing these sectors take a bit of a sideline. Post this correction, I don't know where it's going to stall, but all this uncertainty around the second wave, the national lockdowns across the globe, the US president elections, whenever we do recover, A, is it going to be as straight line and one way up as it was from the March lows? And B, would you again see IT pharma take the lead, or would the sectoral churn, which is already taking place right now, play out, and maybe there will be another leader which is actually going to lead the recovery?
I think you're right. It's very difficult to imagine that you'll see the same kind of straight line curve up, even in a very bullish global environment. I mean, in March, we fell all the way down to, on the Nifty, down to 8,000. We've come back to almost 12,000. That's almost a 50% rally. Highly unlikely we'll see that kind of a rally once again, even in the very bullish global economic and monetary environment. But clearly, what I think will happen is coming to the specific sectors. While IT and pharma, they have, rallied, and there is a bit of a consolidation taking place, which in our view will actually continue going forward as well. Valuations have become somewhat full. But I think also there has been a meaningful shift in their earnings growth prospects. There has been a fundamental change in the earnings growth outlook for the next couple of years. In IT, we've seen margins actually expand, even though we think the current September quarter margins are unlikely to persist. But by and large, we do expect the margin trajectory to be much better for FY22, FY23, given the cost cutting, given the more offshoring angle which we are seeing in IT. And pharma, likewise, the US FDA regime has become far more benign. The competitive intensity has come off. Companies are actually, past the capex cycle, a bulk of the peak of the capex cycle. So we are seeing free cash flows improve, and there are a lot of new products in the pipeline for a lot of the companies. And the India story, the Indian pharma industry, that obviously, there's a long way to go. So IT and pharma, we think you'll have to be, a little bit patient. But for longer term investors, we still like these sectors. You also obviously have to choose your stocks carefully, keep valuations in mind. But fundamentally, we do like these sectors. But you're right. I think the sector rotation will happen. But I don't think it'll be a broad-based, just one sector. I mean, there's obviously banking, for example. That's a sector we do like. But it's not a broad sector-based positive view. I think you will see a differentiation. I think some of the larger private sector banks, which have a very strong deposit franchise, whose underwriting risks were very good, where management quality is very stable, they should do actually quite well going forward, even in a somewhat weakish industry growth environment, simply because of market share gains. So as and when the economy recovers, credit growth starts coming back, these banks, the banks which have raised capital, which have a solid balance sheet, are already done with the bulk of the NPLs and provisioning and so on. They will actually, in our view, come out looking quite good and may actually start surprising on NIMs and credit growth and operating profits and even credit costs, perhaps. So that's something which we like. But again, within banks also, you have to be careful. It's not going to be a broad-based across the board. Likewise, in NBFCs, while generally we prefer banks to NBFCs, but selectively there are a few NBFCs which are well capitalized, where the asset quality has not been so badly impacted, where the liability side is now taken care of, which have a good parentage as well. So those kind of NBFCs will do well. And then you can look at, selectively a few sectors where there are market share stories and so on. But you're right, it's not going to be IT and pharma once again.
Sure. Pratik, great to have you on the show today. Would have loved to chat a lot more, but lots of earnings to number crunch, so running a little tight on the show today, but good speaking with you nonetheless.